This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
It's another big day in which we find Boeing once again in the spotlight, this time up on Capitol Hill. The Federal Aviation Administration's top official pledging to hold Boeing accountable for any quality lapses as the agency examines the U.S. plane makers' manufacturing processes following a near disaster on an Alaska Airlines flight last month. Here's FAA Administrator Mike Whitaker before U.S. lawmakers earlier today.
The events of January 5th, it really created two issues for us. One, what's wrong with this airplane? But two, what's going on with the production at Boeing? And there have been issues in the past, and they don't seem to be getting resolved. So we feel like we need to have a heightened level of oversight.
That's FAA Administrator Mike Whitaker before U.S. lawmakers earlier today. Boeing shares, they are up now, but are down nearly 16% since news of the incident. Meantime, another new risk looms, a labor rift 10 years in the making. And also, yesterday, news on some misdrilled holes on the 737. Carol, let's get to the interview.
Let's do it. With us, George Ferguson, Bloomberg Intelligence Senior Aerospace Defense and Airlines Analyst out there in our BI headquarters in Princeton, New Jersey. Also back with us, Bloomberg News Projects and Investigations reporter Peter Robison. He's also author of Flying Blind, the 737 MAX tragedy in the fall of Boeing. He's on Zoom out there in Seattle. All right, FAA Oversight. What more are we learning? And George, let's start with you about the tone and tenor of the FAA when it comes to Boeing.
I think what we heard today was the administrator told us that until now it's been largely auditing and not sort of a physical presence at Boeing, and now they're gonna have an increased presence or physical presence at Boeing and at Spirit AeroSystems. I think there's still a lot more to be learned here. Right there in the middle of conducting some surveys and such that I think are going to guide what level of oversight they're actually physically going to have on the ground, but there's absolutely going to be a presence of the FAA, again, at Spirit and at Boeing.
Hey, I want to bring in Peter Robison, the author of Flying Blind, the 737 MAX tragedy in the fall of Boeing. He joins us on Zoom from Seattle. Hey, Peter, just a headline crossing in the last few minutes that Boeing's key 737 supplier, that's Spirit AeroSystems, to tie CEO pay closer to quality. There's a long history of Spirit AeroSystems and Boeing going back many, many years. Ultimately, it was spun off just about 20 years ago, close to 20 years ago at this point, I should say. Does tying executive pay to quality, is that the type of thing that will move the needle here?
I mean, it's certainly something that you would hope does, change CEO behavior. As you pointed out, this is a problem that's been many, many years in the making. Where many of these 737 production problems are happening is at a separate company called Spirit, which Boeing used to own, and it was Boeing Wichita. And since then, Spirit has had a very difficult time keeping costs low enough and meeting the pressure to keep costs low as part of as it's positioned in a different part of the production system.
Right, we do have another headline from the Spirit Aero CEO now behaving as if we were part of Boeing. Also, that Boeing 737 MAX 9 accident report released by U.S. investigators. So we'll look for some more headlines on that. Having said that, Peter, this 737 MAX program, why are there so many ongoing issues? It's just because it's the dominant program for Boeing right now, or what is it?
I think it does go back all those decades. It's Boeing's attempt to change its entire production system, and it really lost control of the production system. This incredibly important part of Boeing that makes the fuselage was no longer part of Boeing. So when you're dealing with a different company, you have an extra layer of overhead. You have an extra layer of management. You have a lot of wrinkles in the process that weren't there before, and as that headline suggests, if this company were part of Boeing, some of these issues may not have happened. You had a lot of rework happening, arguments over the rework. It created a lot of difficult coordination issues that both companies are still wrestling with.
Peter, does it call into question Boeing suppliers with other relationships as well, and sort of the whole structure of the way that a plane is put together? It's the sum of its parts, and Boeing is doing the ultimate manufacturing. But these parts come from all over the world.
It does, and just referring to another one of those headlines, which is a story by my colleague Julie Johnson, where the machinists are asking for a 40% raise in their next contract. That's really a result of Boeing squeezing them very hard the last time this contract was negotiated in 2014, where those workers had to take a 4% increase in pay over essentially a decade. And many studies have shown that the experience of your labor workforce in aerospace directly affects productivity, and there's a strong correlation there. And at Spirit, especially after the pandemic, they lost a number of workers trying to retrain new workers, and that's very costly and difficult, and it leads to a lot of work being done out of sequence, which increases the risk of quality problems.
All right, we fixed our technical glitch that we had with our George Ferguson. Obviously, glitches are much easier sometimes for us to fix than Boeing. We understand that there are a lot of moving parts and a lot at play. George, of course, Bloomberg Intelligence Senior Aerospace Defense and Airlines Analyst out there at our BI headquarters in Princeton. You've been listening to the conversation here. You do wonder, and we've talked with you before, George, and I just want to mention NTSB now, a headline says Alaska Air Boeing MAX 9 door plug was missing the bolt. So obviously, we're just going to continue to get some headlines here. When you think about this program, this way forward for Boeing, it's so important, obviously that they get it right. But I also think about the importance as being the largest U.S. exporter, right, of the United, how important it is for the U.S. as a country, as a government, that Boeing kind of gets its act together as well.
I think it's critically important. They are our aerospace champion. We want to be a competitor in commercial aerospace, commercial aircraft manufacturing. There's lots of countries around the world that want to be in this business as well. The Chinese want to be in the business with Comac. They're working on coming up the curve in the business. The Japanese do a lot of subcontracting to Boeing. I think they have one of their own airplanes they were trying to develop a couple of years ago. They'd like to be in the business. The Brazilians have their aircraft. Everybody knows that it's high value manufacturing. It's good paying jobs. I think it's good for the economy of these countries, build strength in their engineering talent pool. And so I think it's critical that the U.S. maintains a lead in this business. It's a strong source of economic activity.
George, help me understand a little perspective. We're good about doing that here at Bloomberg in terms of context. And I think about my dad, who was an engineer, aerospace, said it's probably safer to get in a plane than it is to get in your car. Having said that, when there's an accident, it really, and rightfully so, gets a lot of attention. I mean, how do you think about what's happening with Boeing against kind of the broader plane industry? I mean, how do you kind of put it in its place, if you will?
So, I mean, if you think about sort of the broader manufacturing industry, one of the ways I think about Boeing is that, I think going back to the speaker too, it's this is one of those industries where people really, really matter. It's not in the U.S. I think a lot of times we like to build jigs or we use capital equipment, tools that help the worker build a product and help control the quality as we make that product. And that works really well for things like auto manufacturing, where you're putting 400,000 units through a factory in a year. These are not factories that are that high of volume, so it's hard to get machine tools, customized machine tools to pay for themselves. And sometimes a lot of the curves and situations you're manufacturing are really hard to get access to, so it's hard for a machine tool there too. The Spirit CEO talked about that today on the call. So it comes down to having really skilled people on the line that can do the job. And that means you have to build into them. You have to train them. You also have to make sure there's strong supervision of them. And I think before the pandemic, we had enough of the older talent pool in aerospace manufacturing that maybe we didn't need as much supervision. Maybe we didn't need as much training because they'd been there for years and years and years. That's turned over since then, and so now that old playbook doesn't work anymore. Plus, a lot more of this supply chain is going international, and now these companies have to control for what's coming out of factories in Malaysia and in Korea and in Japan. So Peter, it's become a lot more complex.
Yeah, it is a lot more complex. It's something that we've spoken a lot about, especially now that these engineers, if you're interested in this type of thing, you're not just going to go look at Boeing as a place to work after college. You could go work for SpaceX, you could go work for Blue Origin, you could go work for many of the number of companies down in Southern California that are doing really interesting stuff. Boeing has a lot of competition for talent. Hey, Peter, I want to bring you back in here and just talk a little bit about the defense portion of Boeing and how that kind of changes the story. Last year, Boeing brought in $25 billion in revenue from defense, space, and security. It's an absolutely huge government contractor. How does that change the story about the way lawmakers are thinking about Boeing and what it needs to do to dig itself out of this hole?
Well, I mean, you could make an argument that it's too big to fail. It's so critical to the military and to, as George was saying, to the industrial base of the country, that there needs to be a solution of some kind worked out. And it's especially telling that Boeing moved its headquarters to Arlington, Virginia, which perhaps shows where it expects to be spending a lot of its time and resources in coming years.
All right. So then the story on the Bloomberg about, kind of one of the next risks for Boeing specifically is a fight with its largest union, long in the making. So, George, they're looking for 40% pay raises. They're willing, it sounds like, to go on strike. They don't want to do it. But are they right in these pay demands? And how does that kind of squeeze Boeing even more?
I mean, look, labor is getting these kind of increases, at other places besides Boeing. Spirit Aerosystems labor already got their increase as well. They live in an environment that was much more inflationary. They've gone through a patch of inflation that's raised prices, compared to pre-pandemic. And so I do think they deserve it. And these contracts only come up every so often. Like you said, it's been a decade in the making. Mm-hmm. So their union leaders aren't going to walk away from an increase here just because Boeing is having some challenges. Those workers can go other places. Like you said, there's other aerospace manufacturers they can go to. There's tech companies up in the Northwest. Those workers need to get paid what the prevailing rate is, and they deserve it, and they're probably going to get it.
Peter, come on in on the labor issue and what you think that might mean for Boeing going forward.
You could argue that the leverage is in the union's hands this time. In 2014, it was very low inflation. Boeing had the work for the 777X, which it was threatening to move out of state, and that was seen as a real serious risk to many people in the union. So they sort of grudgingly went along with the package. Now, Boeing critically needs these workers to dig itself out of this hole. So it's hard to see this not leading to the union having a lot of leverage in these talks.
Hey, guys, one last question. Just got about 50 seconds left here. George, the overhang of this, I don't know, how are you looking at it? Is this going to be 6 months from now we're still talking about this, or 6 months do you think Boeing will have turned the corner? Just quickly.
Well, I think the costs are going to last for a while, and quality needs to be fixed long term. So we'll be talking about this in 6 months.
Peter, come on in on that as well.
I also expect to be talking about this in 6 months. The union contract expires in September.
Peter, I think there's a second book here. I'm just going to say. Guys, certainly a story that is an important one and one that we continue to really appreciate your input. Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst George Ferguson out there on BI headquarters in Princeton, and Peter Robison, Bloomberg News Projects and Investigations reporter, author of Flying Blind.
And if you are just joining us, we should note a headline just crossing the Bloomberg terminal. The Boeing 737 MAX in Alaska Air accident back on January 5th was missing bolts. 4 bolts that acted as a fail-safe mechanism to hold a panel in place weren't installed on the Boeing 737 MAX 9 jet. That's according to a preliminary report from the National Transportation Safety Board.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, small businesses, the backbone of the U.S. economy. Government data shows that these companies account for 2 of every 3 jobs that have been added in the past 25 years.
Yeah, it's important. And the most recent reading, I should say, on the small business community, it found that U.S. small business optimism ticked up to a 5-month high in December, largely reflecting less pessimism around sales, earnings trends, and economic expectations. That reading just about 1 month ago. We're going to get another read on U.S. small business optimism about 1 week from today, but we actually are going to get one in just about 5 seconds.
That's because our next guest is a member of that all-important engine of the U.S. economy. Very pleased to have back with us Christina Stembel. She's founder of Farmgirl Flowers. It's a business that if you're a listener or viewer of the program, you certainly know it well. It's also a business that she bootstrapped some 12 years ago and has built into a $30 million business. She's joining us here in the Bloomberg Interactive Brokers studio. Christina, welcome back to New York.
Thanks for having me. I love talking about business, the business of flowers. So
well,
how is
the business of flowers? How is your world right now?
Yeah, I mean, we're gearing up for Valentine's Day, which is always a lot of pressure. It's the second largest holiday of the year for us, so there's a lot of anticipation.
Remind us what percentage of your revenue comes from just Valentine's Day.
It's lower than you think. It's about 15%, but Mother's Day goes up to about 20%.
Okay, so
20,
that's
25.
35% of all of your revenue
Yes.
from 2 different days.
Yes, in 2 weeks, basically, of the year.
Are those the 2 biggest holidays?
Yes, absolutely.
All right, so, okay, a favor, like back out the holiday stuff, because, right, there's expectations around that. But in general, when you look at the U.S. consumer, how have they been ordering just kind of on every other day or just normal days, if you will?
Normal days are down. I wish I had the optimism that the reports are showing right now.
Really?
And I think I'm optimistic about next year. So I think maybe that's where some of it's coming from. Like, after COVID, post-COVID, I think that there's been so much change constantly and where are we going to settle out? And I think, the economy right now, we're in a gifting market. So the gifting holidays are especially important for us. We have to do really well in those gifting holidays because the everyday consumer isn't consuming as much. They aren't sending as many gifts since we're in the gifting space.
When did you notice this change?
2021. We've been going since 2021 on this. So, we were double the size.
So it's been declining since 2021?
Yes, we have, but intentionally. So we could still,
what does that mean intentionally?
Intentionally, we're focusing, I'm really excited to see the market change a bit from growth at all costs. All small businesses, startups, everything Bay Area was all about growth at all costs. Just have those top line revenue numbers grow exceedingly fast. And now we're focused on profitability. So, and I feel like everybody's kind of changed their ways a little bit since we're bootstrapped.
What is it? Wait, what is it that Zuckerberg says? The year of efficiency?
Yeah.
That was last year.
Yeah.
But it's carrying over.
It's bleeding into this, definitely. With layoffs, you see still happening, at a pretty rapid rate. People are, you have to be efficient. You have to run very efficiently to make any profit this year.
Remind us about your staffing and your supply chain. Give us an idea of what that picture is.
Our supply chain has changed 4 times since 2020. So we are constantly changing it to adapt with what the market demands are. And supply chain availability is. So 2020, we had a boom. We were over 60 million in 2020.
I sent flowers during the pandemic to
yes,
people. Yeah. We all probably did.
And people
what else were you going to do?
I know.
You couldn't.
Like, I baked my bread.
Baked bread, drank wine, and sent flowers.
Wine, sourdough, and flowers. It was
exactly.
that was the year, right? So I think, there was that, but supply chain was really hard. So then you have to shift and go closer to the flowers. We were buying a lot more in North America at that time. Now we still are buying more in North America, closer to home.
Was that because planes weren't coming?
Yes.
So
yes.
they're not. These are not planes that are exclusively filled with flowers. These are planes that sometimes have people on them.
Yes.
And it's hard to ship this stuff if those planes aren't flying.
Absolutely. So unless you're going to charter a plane from Europe, when there weren't as many planes going in 2020, you would have to figure out other ways to get flowers, to you. So we were literally in box trucks picking up flowers that time, and then, things have shifted. Supply chain's gotten better, but everything's gotten more expensive. So then you're also, outbound transportation, went from about 26% of our revenue to 41%
That's
overnight.
when gas prices spiked?
Really just, I would, I guess, I don't know if I should say this, but I think it's also linked to stock prices for those companies in 2020. If you look at those for UPS,
well, go there because I've had conversations with some publicly held companies as well, and just talking about prices, like why are they still so high? And smart people scratching their head and just wondering whether folks are keeping prices high because they can.
I think that things have gotten more expensive. Labor is a lot more expensive. So, I know that personally with our company, so I can imagine at the transportation companies, it's the same.
Yeah.
When you're paying a lot more than you were a couple of years ago, where, wages have inflated much quicker than they did in previous, decades. So, that has to be reflected. And I think, American consumers have been taught by certain large companies that shipping should be free, but it's not free. And that's
a good point.
Good has to pass a lot of people's hands and a lot of trucks and a lot of planes and a lot of gas. And
especially if you're shipping something that's perishable.
Absolutely.
And that has to get to a destination within a certain amount of time, or else it's not going to look or smell as good.
Labor market, can you find all the workers you want?
No. I should say yes, but you pay more. You pay a lot more for the same job.
How much have wages gone up as a cost of doing business for you guys?
I would say about 30%.
Okay.
25 to 30%.
That's since 2020?
I think, it started in 2020 and it's continued to rise. I also think professional labor has gone up as well. It's not just wage level that's gone up in prices. Also, working from home, I think productivity is in question sometimes a little bit. It's harder. It's just not that, people aren't working. It's just really, it's not efficient. You have to have 6 meetings to get things done that would take 1 in person.
Is that what you're doing at Farmgirl Flowers? Are you hybrid? Are you remote?
We are remote mostly. I mean, in facilities, people are working, but remote for a professional level.
Okay.
How much?
Go ahead.
I was just going to say, while we're talking higher costs, how much of pricing or the pricing pressures you are feeling as a business owner, how much can you pass on to consumers? Or are you kind of swallowing a lot of it?
Both. So
Okay.
we have raised our prices in some things. Our core product offerings, we haven't raised those prices in 3 years. We're probably going to need to because our margins are just so tight. But American consumers also, they're hurting right now. When it's $8 for a dozen eggs, they can't spend as much. So it's also making sure you don't price yourself out of the market.
Egg prices have gone down.
Have they?
Yeah, egg prices have gone down.
Good.
Okay, don't
I
worry.
just paid $7.99, but
oh, you got to shop somewhere else.
Yeah, maybe the free range thing. I don't know.
Yeah. Well, are you in the Bay Area?
I'm not. I'm in Washington State.
Okay, you're in Washington
Just
State.
buy eggs that were in prison. Like that's what, I'm just kidding joke.
Come on,
I don't want the email that I'm going to get.
Okay.
No.
Okay, so let's talk a little bit about, we were talking about your supply chain. Here, fast forward to 2024. Where are you getting your flowers now?
All over. North America, South America, Europe. Mostly, I would say I need to do an audit to see what the percentage is. I would say it's over 50% US, but slightly. So it's about half and half probably.
So you think just like we talk about this with everybody, this idea of kind of pushing back against globalization or just having kind of nearshoring, onshoring, it makes sense and probably will continue, do you think? Or if all of a sudden it makes sense to buy outside, you will?
Absolutely. I mean, you can't get enough flowers in the U.S. of all the type varieties you need. So it's just there's a sourcing shortage of certain varieties. Also, gas prices, heating greenhouses in certain areas, especially, on the East Coast, the heated greenhouse is way more expensive than importing those flowers. And so the farmers know that and they just don't heat them through, certain months. And so you have to subsidize during certain times of the year.
Hey, real quick, you bootstrapped this company. You have funded it yourself, partly because a lot of VCs passed on this company.
Yeah.
What's the exit plan for you?
That's a good question. We should talk about that for a long time. I built it to sell. I don't know that that's the trajectory anymore for us, so we'll see. Building a long-term sustainable business, there's nothing wrong with that, though, and we don't talk about that.
Agreed.
It's not like the sexy, cool thing to talk about in all the magazines.
But I think that's because so many of these businesses are venture-backed and they have investors breathing down their necks saying,
Absolutely.
we need our return.
Absolutely. I actually feel like we're extremely fortunate right now to not have that happening. A lot of my friends that are CEOs that have that same story, they are being forced to show some growth numbers or at least a flat year. And our goal is a flat year this year with profit, but there's no path to profitability. Like overnight, they were like expected to make mom jeans into lowriders again.
Right.
You can't do that, right? And so they're like, growth at all costs, now profitability.
Well,
and, we've always had to be profitable.
Was it the owner of Rome that we talked about that kind of had investor money come in and then kind of the business got away and then he got back much
Nate
more
Checkett's.
involved. Nate Checkett's more involved in it. So, well, when or whatever the next stage
Or
is.
just come back.
Yeah.
Just
come back.
You're in New York.
I mean, we might be a long-term business.
I
I might
think
be here for many, many years.
I think it's great, and I would
Thank
say
you.
your workers and your supply chain would appreciate that. No doubt about it. Good luck on this Valentine's Day.
Thank you. Thank you so much.
So appreciate
you
it.
having me.
Christina Stembel, founder and CEO of Farmgirl Flowers.
This is Bloomberg Businessweek, insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Businessweek with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, we've got a new stock on our mind on this Tuesday, February 6th, and that's Ford. Ford shares off their highs in the aftermarket, but still up about 7.3%. This as the company beats profit expectations, sees more earnings growth ahead. And listen, they gave an outlook, right? They didn't say we're backing off of it. They gave it, and it was well above what the street was expecting.
Yeah, $10 to $12 billion before interest and taxes. That compares with $10.4 billion on that basis in 2023. The result was on the high end of the $10 to $10.5 billion that the company predicted back in November. That, Carol, was when it lowered guidance following a 6-week strike by the UAW.
All right, let's see what Ivan Feinseth has to say. He's senior partner and CIO over at Tigress Financial Partners. He's on Zoom in New York City. All right, what say you, Ivan, in terms of what we just got from Ford? Because investors certainly like it in the aftermarket here. Stock's still up about 7%.
Well, we got a lot of positive macro trends for the auto industry. One, jobs. The job numbers continue to be great, which means people are working. And when you're working, you need a car to commute to work, and you have money to buy a car. Number two, we still have a significant pent-up demand cycle that has come from both the recent UAW strike and the shutdown in production that we experienced during the pandemic that the industry really has not yet to recover from, but is ramping up production. So you got strong demand, you got consumers able to buy cars, and you got GM and Ford both have a significant cash cow, in their truck business, which are the best-selling vehicles that they make.
Strong demand for what, though? Strong demand for internal combustion engine vehicles like the classic F-150, like the Ford Bronco,
yes.
or demand for EVs?
The Ford Bronco still very strong, the F-150. And while consumers and the industry does want to make the transition to EV, unfortunately, we need this middle stepping stone of the hybrid cars that are both, gas EV powered as the nationwide charging network ramps up.
Ivan, hang on for a second. Just a headline crossing. Shares of Snap are down about 19-20% here.
What?
In the aftermarket.
Oh, man, this company's being crushed.
The company coming out with an update saying it sees first quarter revenue $1.1 billion to $1.14 billion. The estimate on the street is $1.11 billion. Sees a first quarter adjusted EBITDA loss of $55 to $95 million, much more than what the street has been thinking about. The estimate loss of $32.7 million. Also talking about fourth quarter daily active users, 414 million versus an estimate of 411.59 million. So that's a little bit better than forecast. But that outlook and really that first quarter adjusted EBITDA loss has got to be worrying investors.
What's interesting, though, is it beat on the fourth quarter adjusted EBITDA significantly, 159.1 million versus estimates of 111.
But it's the outlook.
Looking forward, I know.
It's like, what have you done for me lately?
And I think the question is, what is Snap doing, or what is Meta Platforms doing that Snap isn't doing? Because these two stocks certainly diverging. All
right, Snap shares down about 20% in the aftermarket. They were up just slightly on the year. All right. From Snap back to Ford we go, because Ford up about 6.5% in the aftermarket following their earnings and an upbeat outlook and also a dividend. This first quarter supplemental dividend of 18 cents a share. We were talking about that with some of our colleagues. Is this a one-time thing? Is it just to kind of appease investors until they kind of get the product mix right?
Well, I think that both GM and Ford have announced significant amounts of returning of cash to shareholders, driven by the tremendous cash flow that they have from their ICE and truck vehicle business. And that, again, shows the strength of their cash flow and the confidence in their cash flow. And as they have enough capital to both return money to shareholders and continue to invest in their EV transition.
I will say, looking at the press release, they talk operating cash flow, $14.9 billion for all of 2023. They say solid adjusted free cash flow of $6.8 billion was significantly better than the company's outlook of $5 to $5.5 billion. Ford's balance sheet remains strong with nearly $29 billion in cash and more than $46 billion in liquidity at the end of the year. I'm reading just straight, Tim, from Ford's press release.
Hey, Ivan, do we get to the point in your opinion where in any time in the next few years we're going to see the same number of EVs sold as ICE vehicles sold by a company like Ford?
Well, both Ford and GM had predicted that more than half of their auto production by 2025, the end of 2025, would be EV. They both kind of walked this back, but we have both the auto industry trying to move forward to increasing the mix of EVs to 50% and eventually 100%, and then bumping up against government mandates that in many cases by 2035, they will only be able to sell EVs. And both Ford and GM had kind of projected that they wanted to get to that level before by 2030, which both are not that far off. So you have the industry wanting to move in that direction. In theory, consumers want to move in that direction, and the companies want to move in that direction.
Yeah, they talk about Ford Model E's wholesale and revenue were both up at double-digit full-year rates. They also say by the end of 2024, 60% of Ford Blue's global vehicle lineup will have been recently refreshed. And they also talk about hybrids. And they said they sold about 700,000 hybrids worldwide over the past 3 years. We're expecting double-digit hybrid growth again in 2024. Ivan, we've talked about this on air, that in terms of the automakers, they're just kind of adjusting. Maybe they're not giving up on EVs. It's just the timetable maybe is changing. And then they're just kind of addressing the product mix that their consumers want. And it looks like they are being rather flexible, and that's a good thing that they can do that. Is that fair?
Yes. And I think maybe that both Ford and GM were overly aggressive in their schedule to make the transition to EVs, and both the market, consumers, and the industry in general is not ready for full EV, so they're going to have to increase. And even Mary Barra on her conference call last week said that they are going to ramp up hybrid production to help with the transition. So ideally, I think that really will meet a lot of demand, because consumers want to go electric, but they're not ready to go all electric. And the charging infrastructure is not there to support an all-electric auto industry.
What do automakers need to do? What does the U.S. government need to do for the charging infrastructure to get there? I mean, we have gas stations on pretty much every corner in the U.S. That's taken generations to build up. What do they need to do to have the same thing for EVs?
Well, we need three things. Is one, the availability of the charging network, the availability of chargers, and more important, the availability of high-speed chargers, and the technology on board the vehicle to charge faster and for the charge to last longer. And over time, you'll see the batteries will go farther on a charge. You'll be able to at least get an interim charge. In many cases, they're talking on a 300-mile battery, 100 miles within 20 minutes. And you're going to see this network of gas stations, I believe, eventually evolve to a place where you can charge and then spend a little bit more time than the 5 minutes it takes to buy a tank of gas. You're going to need, 15, 20 minutes to charge your vehicle. That's why a lot of the gas stations have restaurants and convenience stores and places to sit. So all this is going to come together. I believe that you see a lot of new gas stations being built with convenience stores and more consumer services within them.
They're going to become like airports. I can see it.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just 18 minutes left in today's trading session. It is time for the drive to the close. Speaking of driving crazy, I think what really drives us crazy in 2024 so far, Tim, this year, is not necessarily what's going on the equity side of things, but it's the Treasury trade. I mean, here we are.
Why is it driving you crazy?
Well, we're back. We're at 440 on that 2-year note. We've moved down a little bit, but the last 2 days have just been wild.
How's that 10-year looking?
10-year, we're looking at 408. So we're staying above that 4% mark.
Yeah, yesterday was 4.1%. 4.15.
We've been higher, right? And our own Mike McKenzie was talking about going to 4.25 on that 10-year.
Yeah, he's got folks he knows the folks who are ready to buy when it hits. If it hits 4.25 this cycle.
And is that ultimately the peak when it comes to the 10-year? All right, lots to get to, not just treasuries, but obviously important, but also on the equity side of things, really how investors are thinking in general about the investment environment. Let's get to it with Liz Young. She's head of investment strategy at SoFi. She joins us on Zoom in New York City. Hey, Liz, good to be talking with you again. How are you, and how do you think about this environment? What is kind of top of mind when you think about investing right now?
Yeah, well, thank you for having me. Good to be back. One of the things that I think is happening right now is, we spent most of 2023 looking around the corner for a recession that didn't happen. And now in 2024, it seems like the market is declaring that it's never coming. And I don't think that either of them will prove to be correct. Obviously, we were already wrong about 2023 having a recession. For 2024, the idea of we've already accomplished it and we have the soft landing, it's occurring. I don't think that that's going to end up necessarily being the case, although today that is how it feels, and that is what the data is suggesting. But the idea of the business cycle not really being over yet because we haven't started cutting rates. We've just had the hiking cycle and we're still seeing a lot of late cycle behavior in the markets. I just don't want investors to declare premature victory on a soft landing and be caught flat-footed.
Well, one really smart sign of how investors feel about whether or not we've got victory is what's been going on with money markets. And I think about the headline we got on February 1st, money market fund assets reached $6 trillion for the first time. That's a very clear signal from the investing community about kind of how they feel about taking on risk. What are you seeing on the SoFi platform that shows the tolerance, the risk tolerance among investors?
Well, what's interesting about the money market trade is that you can sort of slice it two different ways. You could say, in a very straightforward sense, money is going into money markets. That must mean people are scared. When I really think it's more about a rational investment decision. So if you're going to be able to get 5% in a money market, and I'll throw things like short-term treasuries into that too. If you can clip a 5.2% coupon on a 6-month treasury, why not, right? That's a rational investment decision. So while rates are still in this range, and as we've seen, you talked about at the beginning of the show, as we've seen the 10-year stay above 4% now, there's a lot of volatility, but it's still pretty high. So money markets aren't necessarily right now sending the signal, to me at least, that people are scared. I think they're sending the signal that people are trying to make money in income generating assets. And as rates fall, whenever the Fed starts cutting, that's when money markets start to become less attractive. But that'll be the telltale sign, is if people take money out of money markets and put it into other income generating assets, or if they take it out of money markets and put it into really risky assets or growthy stocks in the S&P 500, for example.
What do you think happens to those money market funds?
Well, to be honest, I'm surprised that it continues to rise. I'm surprised that the balances continue to rise, because I don't think that they've necessarily got more attractive since the end of last year. But if we continue on this path where the soft landing looks evident in the sense of, okay, the labor market hasn't cracked, inflation has come down. If we were on a path where the Fed was going to start cutting rates in March and this data still seemed good, that's where I think money market funds lose some assets and it goes into risky assets, because that would be supportive in that environment. That has changed. We have now all but priced out a cut in March and expecting a cut maybe in June, maybe it's May, but it continues to get pushed further and further out into the future. So I think the longer the market expects the Fed to wait, the more nervous people will get about them waiting too long to start the cutting cycle, in which case, if and when money does come out of money market funds, it stays in some other safe haven asset.
What other safe haven, though, would you expect it might go if people are really nervous?
Gold. I think gold, it's obviously seen quite a big run, but if people are worried about the value of the dollar, if you see rates come down very quickly and the value of the dollar come down very quickly, you want something that's a store of value, and gold continues to be that option. I think you might also see money still flow into treasuries, and you might see money flow into longer term treasuries if people start to get worried about the data. You might also see things like the really defensive parts of the stock market. Utilities has lagged quite a bit this year. You might see utilities catch a bid. Consumer staples has seen some of that, and even parts of healthcare if people aren't quite ready to completely get out of the stock market.
I feel like the world would have to be coming undone if everybody was running to the exits and throwing stuff into gold or even utilities, right? Like, I just feel like it would have to be pretty dire. Is that fair? I mean, Liz, is that how you would see it? I don't know.
Well, it doesn't have to necessarily be a rush, right? It could happen just in sort of a slow fashion where people are slowly taking money out of something that isn't quite yielding what it used to yield and putting it into something else, but they're not ready to go all in on the risk table. So I don't think it necessarily has to be a big flood. I do agree that in order to see some huge rush to the exits out of the equity market, especially after a time where momentum seems to be pretty strong and there's clearly buying appetite out there, you would need a catastrophic sort of data print or a few months in a row where things went bad, or you would need some kind of headline. Now, of course, that's always a risk. That continues to be a risk, but I don't think we've solved all of the problems. And we have question marks about a lot of things still remaining.
Hey, Liz, we're seeing shares of Palantir up by 30% right now. We were reminded by our own Mandeep Singh a little earlier that Palantir was a meme stock. And I'm wondering if you're seeing any sort of meme stock behavior on the SoFi platform that reminds you of where things were in 2020, 2021.
I don't think we're at that point. I think, obviously the market has seen a handful of stocks really lead the way. And it's interesting that the Magnificent Seven has now become sort of the Magnificent Four, and we've got a new stock in the mix. So it continues to narrow. And it's just the idea, not necessarily, I wouldn't call it meme stocky, but the idea that you've seen double-digit moves in some of these names over really short periods of time. Some of those moves have happened over a month. Some of those moves happened over a 2 trading day period. When you see moves that big on news that maybe doesn't justify a move that big, it starts to feel like excessive risk taking.
Yeah.
And the thing about that, though, is momentum is strong. It'll continue until it stops. And if you can call that time, good for you, but most people can't.
We know the rules, or what everyone has always said about market timing. Hey, Liz, thanks so much. Be well. Liz Young, she's head of investment strategy at SoFi.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.